Before you look at the next price candle, pause and ask yourself one question. What if the metals market is not reacting to fear, but quietly repricing the global financial system in real time? Because that is what disciplined investors are starting to notice. While most headlines focus on short-term volatility, the deeper signals are coming from physical shortages, central bank reserve shifts, record monthly momentum in silver, tightening liquidity in private credit, and a housing market that has stalled at historic lows. These are not isolated data points. They are structural movements across currencies, commodities, and credit markets happening simultaneously. Silver approaching a historic 10-month green streak is not just a technical milestone, it is a reflection of capital moving with intention. And when capital moves before the narrative adjusts, the informed minority gains the advantage. Today, we are not discussing hype. We are dissecting balance sheets, positioning data, reserve flows, and intermarket signals, the kind of information professionals use to prepare before the crowd recognizes the shift. Imagine a market where a seller hands you cash back instead of the metal you contracted for that act alone, rewrites how you should think about price moves. Over the past weeks, credible reporting and on-the-ground accounts surfaced that a number of Chinese retail outlets paused bar sales and, in some cases, refunded pre-holiday orders rather than sourcing inventory for delivery. Those operational decisions are not an academic indicator. They are the clearest real-world expression of physical tightness, the supply chain literally failing to meet demand at the retail level. This dynamic matters because futures and price charts ultimately reconcile with physical reality. When retail outlets and local exchanges experience constrained flows, whether because imports are lagging, domestic inventories are thin, or trading platforms face regulatory scrutiny, the available metal to satisfy delivery dries up. Recent regulatory interventions and platform stresses in China's retail hubs have amplified that effect, prompting market participants to question whether spot and paper markets are fully reflecting physical scarcity. Data from established market watchers adds context to these operational signals. World Gold Council updates show that Chinese net imports and bar and coin demand have been unusually strong in recent months, even as full-year import figures lag prior peaks. That combination, elevated retail demand against constrained import flows, intensifies local shortfalls. In parallel, third-party commodity desk analyses noted inflows into physical bars and coins ahead of the holiday, pushing local demand metrics to 12-year highs in some reports. Those metrics together turn anecdote into systemic signal. Operational shortages also propagate through the plumbing of the market. Delivery fails, inventory drawdowns in London COMEX vaults, and tighter lease and financing costs for bullion. Traders watching these plumbing metrics often adjust positioning before the broader market narrative catches up. That's why delivery anomalies and rapid inventory declines merit immediate attention rather than retrospective rationalization. Independent analysts have noted spikes in delivery stress and conjectured that paper markets can understate the immediacy of physical squeezes when retail demand concentrates in a major consuming economy. From a practical investor standpoint, operational evidence refunding orders, halted bar sales, platform rule changes, and rising retail demand is higher quality information than sentiment headlines. It reveals where liquidity actually sits today, not where models assume it should be. Recognizing that distinction is how professionals separate noise from tradable signal. Picture this. Major market participants expected Chinese demand to be muted during the Lunar New Year, but instead the metal held its ground, and that detail changes how you think about price discovery. Spot gold's resilience through the holiday period was not a trivia point. It was a real-time stress test of whether price was being driven by paper liquidity or by durable structural demand. When trading volumes thin and one of the world's largest buyer bases goes quiet, the conventional expectation is for price weakness. That didn't happen. Reuters, operationally, two separate observations matter, and together they form a stronger inference than either does alone. First, headline price levels stayed elevated near the $5,000 band, even while Chinese markets were largely closed for the holiday, demonstrating that offshore positioning and central bank accumulation were supporting price in the absence of immediate retail demand. Bloomberg second, anecdotal but verifiable reports from China's retail network shops, suspending bar sales and refunding pre-holiday orders, point to localized physical tightness that paper markets may not fully price until delivery mechanics break. That on-the-ground behavior is not noise. It's an early warning indicator that local liquidity is constrained. South China Morning Post. Why should a disciplined investor pay attention? Because markets that hold, without a major buyer present, are usually being supported by deeper hands, sovereign and institutional buyers or concentrated dealer inventories being run down. The World Gold Council's data on imports, stock changes, and retail flows shows patterns consistent with heavier accumulation in recent quarters, which turns the simple observation of price stability into evidence of structural demand rather than a technical pause. That transforms a short-term narrative about thin holiday liquidity into a longer-term thesis about imbalance. World Gold Council. Finally, overlay a macro shock and the implication becomes even clearer. A sudden event that weakens the dollar or increases policy uncertainty will find a market where physical availability is already tight, making the initial price reaction larger and more persistent. That's what traders saw when tariffs and geopolitical headlines pushed safe haven flows. Gold acted like a market with active buyers beneath it, not a speculative fluke. For professionals, the lesson is straightforward: verify where physical liquidity sits before trusting short-term momentum, because a market that can absorb shocks while an expected demand engine is offline is likely being run by balance sheet buyers who change the rules of engagement. Ask yourself this: if reserve managers are quietly rebalancing away from a currency that once made up nearly 3/4 of global reserves, what does that do to the premium investors place on real assets that sit outside the banking system? The dollar's share of allocated global foreign exchange reserves has moved decisively lower. Recent IMF COFR data shows it near the 56-57% range, a structural retrenchment from its roughly 72% peak 2 decades ago. That shift is not cosmetic. Reserve managers operate on multi-year time horizons and are highly sensitive to long-run balance sheet risk. Persistent U.S. deficits, rising debt levels, and episodes of political uncertainty change the calculus for central banks and sovereign treasuries. As allocation committees diversify, demand for alternative reserve instruments, including gold and other currencies, grows not because of short-term headlines, but because portfolio construction dictates it. Reuters reporting and IMF analysis both document central banks increasingly eyeing diversification into gold, the euro, and other currencies as part of this reallocation. The mechanics matter. When a large official buyer reallocates from dollar assets into gold, the market impact is amplified because official purchases are large, persistent, and often sterilized through long-dated swaps or other balance sheet maneuvers. World Gold Council statistics show central bank buying remained elevated into 2025, contributing materially to quarterly demand and inventory dynamics that underpin price discovery in the physical market. That level of official sector interest changes the supply-demand equation from a marginal retail story to an institutional balance sheet phenomenon. From an investor's perspective, the implication is straightforward. Declining dollar dominance increases the strategic case for assets that serve as reserve or hedge proxies. This does not guarantee uninterrupted price appreciation, but it alters expected returns and tail risk profiles over multi-year horizons. Professional allocators adjust position sizing, liquidity buffers, and counterparty exposure when reserve composition shifts because the correlation matrix they rely on is being rewritten in real time. Studies from central banks and academic research on reserve drivers highlight that exchange rate movements, geopolitical fragmentation, and changing trade patterns are meaningful determinants of currency share changes, not transient sentiment. Put simply, a lower dollar share raises the odds that official and institutional flows will continue to support gold and other non-dollar assets, making the conversation about metals and reserve diversification one of portfolio engineering rather than mere speculation. When you hear that silver has ripped 16% off its weekly lows while managed money long positions sit at multi-decade troughs, the natural reaction should be curiosity, not complacency. The commitments data show that speculative long positioning in COMEX silver is unusually light, a data point professionals watch because it defines how much momentum capital remains on the sidelines and how much room there is for a follow-on move when trend chasers arrive. At the same time, the market's recent intramonth price action, a violent swing that erased a short-lived recovery and produced a sharp 14-16% sessional move, highlights that the move higher occurred without the typical herd of leveraged longs driving it. That combination is strategically important. Price advanced materially, while the speculative community was largely absent, meaning the advance did not require crowded positioning to occur and therefore has a structurally different risk profile than an overcrowded short squeeze. Market historians and commodity traders know that these conditions often precede more durable follow-through when the initial move attracts fresh speculative capital and systematic strategies. Layer into that the monthly cadence. Silver printed an extended string of positive monthly closes leading into this period, a persistence that signals steady accumulation rather than one-off headline buying. When price exhibits this kind of monthly consistency, it changes the interpretation of intraday volatility. Sharp pullbacks can coexist with a higher monthly close because underlying physical and institutional demand are absorbing transitory selling. Institutional flow reports and minor equity moves during the run-up also suggested that parts of the market were pricing forward expectations even as retail and momentum participants lagged behind. Practically, that means a trader or allocator should treat current dips through the lens of positioning asymmetry rather than pure sentiment. Finally, the post-rally price structure and Co-T dynamics imply optionality. The market can move sharply in either direction, depending on the speed and size of new speculative entries. But the path to the upside requires capital that's still off the balance sheet to come on. Historical episodes where price rallies began with light positioning and were later amplified by momentum funds show outsized percentage gains after the speculative cohort re-engages. The present data indicate we may be in that preparatory phase. Ask yourself this. What happens to credit markets and asset allocation when a $2 trillion corner of finance quietly becomes the primary lender for the physical backbone of the AI era? Private credit has grown from niche to systemic in a few short years, and that scale matters because private lenders price liquidity and risk differently from regulated banks. The IMF called attention to the market's rapid expansion and opacity, noting that a roughly $2 trillion private credit ecosystem warrants closer scrutiny precisely because it channels long-dated capital into illiquid structures. Now layer in the financing needs of AI infrastructure. BIS analysis shows that firms building large data centers and specialized compute capacity are shifting from self-funded growth to heavy reliance on external debt, with private credit stepping into the gap. These projects require front-loaded capital and have long payback horizons. If revenue ramps more slowly than modeled, the risk profile of the loans changes fast. That mechanism turns technology execution risk into credit risk for lenders, and by extension for the institutional investors backing those private funds. We already have concrete evidence of liquidity strains inside that funnel. A prominent private credit manager recently halted redemptions from a retail-facing fund and moved to limit withdrawals, a signal markets interpret as a sign either of forced asset fire sales or significant illiquidity in the underlying loan pool. The Financial Times reporting on redemption halts at Blue Owl's retail fund is a live example. Once gates appear, secondary market exits become constrained and valuation transparency diminishes. Data center financing itself is changing the plumbing. Rating agencies and lenders are now tailoring products to securitize and move project loans into institutional balance sheets, but that market is still nascent and concentrated. The Financial Times and S&P reports highlight both the surge in securitized data center issuance and the increasing dependence on large tech tenants to underwrite credit quality. If one or more major tenants renegotiate or delay commitments, covenant strains can cascade down to loan holders who expected stable cash flows. From an investor's standpoint, the takeaway is operational. Private credit's liquidity profile and concentration risk make it a non-trivial transmission channel for stress. Underperformance or slower cash generation in AI projects will not remain isolated to startups or data center sponsors. It will impair NAVs, trigger redemption restrictions, and force repricing of risk across credit lines. That repricing increases the relative attractiveness of real, non-counterparty assets like gold and silver as insurance against balance sheet uncertainty. The connection between illiquid credit stress and hard asset demand is not theoretical. Recent fund freezes and the documented growth of AI-related private lending make it an empirically observable risk pathway. Ask yourself this: when contract signings, the very engine of housing transactions, slow to the lowest level on record, which parts of the economy start feeling the squeeze first? Recent data show U.S. pending home sales dropped again in January, sliding 0.8% month-over-month to a fresh series low and down 0.4% year-over-year, evidence that buyer activity remains muted despite slightly lower mortgage rates and seasonal influences. National Association of Realtors. That headline number masks deeper regional and market structure signals that matter for investors. The declines were concentrated in the Northeast and South, while the Midwest and West showed pockets of resilience, a patchwork that points to localized affordability and inventory dynamics rather than a uniform nationwide collapse. Transaction velocity matters because housing sales drive a wide array of credit flows, mortgage originations, consumer spending on home-related services, and the cash flows that support mortgage-backed securities and related credit instruments. When pending sales drop and closings follow, the immediate effect is lower turnover and slower monetization of housing wealth. Existing home sales fell sharply in January, down more than 8% in 1 month, which amplifies the signal that buyers are stepping back, not just pausing for seasonality. The practical implication for credit markets is a slowdown in new collateral creation and a potential shift in underwriting behavior. Lenders tighten terms, originations slow, and secondary market spreads can widen as transaction volumes thin. From an asset allocation perspective, falling pending sales increase the probability that housing will be a net drag on near-term growth, rather than a cyclical tailwind. That matters because housing is interest rate sensitive and connects directly to consumer balance sheets through home equity extraction and durable goods purchases tied to moves. For fixed income allocators and credit managers, the current pending sales weakness is an input into loss given default modeling and stress testing scenarios. It is not merely a housing headline, but a parameter that affects capital allocation and liquidity planning. Finally, consider the behavioral element. Markets price expected future cash flows. When buyers sit on the sidelines despite modestly improved affordability metrics, it signals confidence or liquidity constraints, not just rate levels. That behavioral inertia lengthens the adjustment period, raising tail risk premiums for assets correlated with credit cycles. For anyone managing portfolios, the prudent response is to re-examine exposure to cyclical credit, shorten liquidity horizons where appropriate, and stress test scenarios where housing transaction velocity remains depressed for multiple quarters. Markets reward clarity, not emotion. Physical supply stress, declining dollar dominance, historically low speculative positioning in silver, early credit market strain, and frozen housing activity are not random developments. They are signals of repricing risk beneath the surface. Volatility will continue. Pullbacks will happen. But structural transitions do not reverse because of a headline. The difference between reacting and positioning comes down to understanding the data before it becomes obvious. Stay disciplined. Study the structure. Combine fundamentals with timing. And most importantly, invest with logic, not noise.